Let's talk about our learning points for today. Number one is understanding business cycle. Then we also talk about factor affecting fixed assets and also method of forecasting fixed assets. One common error that you usually see when people build a model, year one, they will have this capex. If you check their cash flow, they will have this capital expenditure investment in fixed assets. Then for that year, it will now be zero, which in reality it does not really work like that. So let's walk ourselves through how this really work. So then we have our demo. So now let's start with the first one, understanding business cycle. Now every business that is in existence, right, has a cycle, and this cycle exists irrespective of the nature of your business, the industry, the sector you are. Every business has this business cycle, and it always starts with what we call operating assets, right? Operating assets are what you use continuously in generating revenue. For a manufacturing company, definitely their plants and equipment, they keep you using it, right? And you can also relate this to our sales turnover, right? What do they call it? Asset turnover. I'm quite sure we know that ratio, right? Our sales divided by our average assets, right? So that's what they keep using. For a banking industry, what is their own operating assets? Definitely, you know that, oh, they might have those computer and everything, but their core operating asset is those loans they give out to people. For oil and gas, definitely, you know, is that their reserve. Because if they don't have this thing, they don't have anything that they can turn to make revenue, right? For consulting, right? I believe human resources is still one of the best operating assets for a consulting firm. So they use that generate revenue, they manage their cost efficiently, and then they have the profits. So profits now then being converted to cash, and the cash being invested back into the business operating assets. So the efficiency of you using your asset to generate revenue will always give you a good stand of profitability, which in turn turn to cash. So this cycle exists, right? And for the accounting cycle, it's just the recording of this cycle. So thanks to our the brand and office training hub, right? So we've been able to call this out from our advanced financial modeling virtual training course. So in case you have interest, we have a discount for us at the end of the training. So this is part of our material that we use for our virtual advanced financial modeler virtual training course, right? So our operating assets, you always have that in our balance sheet. For the profits, right? You know you have your revenue, you manage your costs, then you have your profits. Everything we have that in our profits or loss account, and the cash reported in the cash flow. So this cycle keeps going around like this, right? Irrespective of the business. So cash is the king of the business. So the cash keep going around. But you know what? Cash can actually leave this cycle, but it's still in the business. Now let's have a chat. Let me see. In what form do you think cash can actually leave this cycle, but the cash is still in the business? Yes, let's type in the chat box. Let me see our understanding of these concepts. So we have a cash operating assets, then profits, then to cash, then cash you invest it back into this operating assets. Now a business can decide that, you know what, we are not investing this back into the operating assets, which means the cash is leaving this cycle. Now let me ask us, in what form do you think cash can leave this cycle? Manuel said stock. So stock. Where we would have made that report in our balance sheet. Don't you think so? Yes. So let me just open that up. So definitely we can have that in form of our profits or cash is either retained in the business. So which means, oh, we are really not this percentage. We are not pulling it into the operating assets, which means we are taking it out, right? So yes, a form like a reserve, retain, earning. Then the other form in which the cash can even leave this cycle and leave the business is in form of cash being paid out to our shareholders, right? So you as a financial modeler, you need to have this understanding. So you know that whenever you are building your model, there's no way a business can have a capital expenditure in year 1 and from year 2 to year 5, everything will be blank. That does not work like that. Every business has their operating cycle. Now let's take a look at factors affecting our fixed assets. Number one is our timing or period, right? We usually have our depreciation lifespan. So more like what that is explaining. Then company policy of treating fixed assets, and most time, uh, when we are having a discussion around some deferred tax policy, right, it usually comes from that concept of, oh, how you've done your own depreciation, aside from the way tax treats their own depreciation. So treating company policy, a company can decide that, oh, you know what, this is how we are going to treat our own assets, this is how we'll be treating our own. So you as a modeler, you also need to understand that before you jump into forecasting the fixed assets, especially when it comes to corporate finance. Then time value of money, which also comes with inflation rate, really affects how we forecast our fixed assets. So by the time we are doing the demo, I will elaborate more on this. Then operating cycle, which I've just run us through. And also, if a business is expanding, if a business is growing, definitely you know that there's no way they will not need to incur some cost on their fixed assets, which is more like their operating assets. Now, different method of forecasting fixed assets. Most people usually get stuck when it gets to this point, right? So let's take a look at a few methods. So the first one is what we call maintainable capex. So what is maintainable capex? Oh, a company has 20 cars, and at any point in time, their policy is, you know what, we will always maintain these 20 cars. So anytime any of the 20 cars get depreciated, all they are doing is, oh, they are just replacing it to always make sure that they have that 20 at every point in time. No, now in forecasting that, we usually make our 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 capex as an element of our depreciation. Then we factor in the time value of money. So when we do that demo, you have that understanding. Then the other one is incremental capex. So incremental capex is saying, oh, we have 20 cars, which means, oh, next period we are going to have 25 cars, or no, we are going to increase it to 20 cars. So that is more with a management decision. Most time it's always hard to get this, but you can get you can have a clue on this. If you check the director's report in the annual report, they might tell you that, okay, you know what, in so year we expect to be able to incur this. I usually have this more when you are dealing with oil and gas indoor companies. Yes, they usually state it. Oh, we expect to do this in order to increase our reserve there. Then the other one is this asset turnover. Asset turnover, right? I usually call it walk back. Walk back. So by the time we are doing the demo, I'm quite sure you will understand that. And the fourth one, yes, is combined capex method. So which you have this 1, 2, and these 3 being combined together. Yes, one interesting thing about that, it usually gives rise to circular reference, and we are going to have a demo on that. So let's jump straight to the demo. Yes, so let me just share my Excel screen. Okay, great. So I hope you can see my screen. You can see my screen. Yes, so this is our template. This is what we are going to use our demo. Now, whenever you build your model, right, try as much as possible to make your model interface look very, very professional. Well, this is our guide worksheet, and this is our input worksheet. Now, most times when people build model, you see them having their inputs. Revenue input assumption in one worksheet, cost assumption in another worksheet, assets assumption in another worksheet, working capital assumption in another worksheet. Based on the fast standard is saying, you know what, anything related to your assumption input, the driver of the model, should always be in your input, just one worksheet. And you can now use this interesting outline, see the way my own model kind of look like, to make it very, very easy for people to navigate. So if I click on this one button that I have up here, you just know that all the assumptions I have here, they are just 2, right? Sub headings, heading 1. Then the heading 2, you can see timing, macro assumption, depreciation. And if I click on the 3, you can see all the assumptions. So let me run us through this assumption that we have. So we have our timing and counter, simple counter. Most times we usually make use of that when we are doing our project financing. We have our year and we have our days in the year. Also note that all your value in your model must have a clear description. Yes, and that's why we have our guideline that has actually details what each and every cell is saying. So you can see our model style guide. right? So whenever you are building your model, make sure that every data in your model has a clear description. Like for example, you know that, oh, this cell is an input cell. So which means you can change this, they have been hard coded. So we have our inflation rates, right? So we just decided to put some fictitious inputs there. Then we have our depreciation. Our depreciation, first we have it in form of percentage, and we also have our depreciation in form of years. I'm going to run us three different techniques. Then the other one, capex assumption, and we also have our financial extract. So let's kickstart the first techniques. The first techniques. Let me open this up. Let me open this up. So we have our depreciation. Most times when we are building a model, and best way we usually train at Libram Consulting, is always your model should be flexible and easy to walk through. Right? Most time when I see people's model, you see, oh, equal to input sell so, then another profit or loss account sell. So it's really not a good way. The way we usually try to do it, you know what? Your assumption, link it straight to your calculation worksheet first, so that people can understand that, okay, oh, this is multiplied by this, and you don't need to be taking your stretching yourself, going straight, working yourself to check, oh, this is input, they said input multiplied by another worksheet. So what I'm going to do now, I'm going to link my depreciation first. So we said this description percentage of our previous PPE, which is more like a driver. So let me link that to our input. Yes. All right. So my inflation rate, let me also link that to my inflation rate. So I'm just trying to link those driver that I need to do the calculation for. This our first technique. So our incremental capex, I link that as well. So one interesting thing, highlight everything and press your Control R, which is what we call left to right consistency. Let me try and minimize this so that we can have everything in one screen. Okay. Sorry, it's too small. All right. So let me collapse this a little bit for us. Okay, great. So our period, we've calculated our period up here as well. So let me link that to what we have here. So exactly. So which means I've actually linked all my inputs back to my calculation worksheet to make it very easy for people to actually flow through, right? Okay, great. So here we have our schedules. We have our schedule, beginning balance, our addition. We call this base, beginning, addition, your subtraction, and your ending balance. So we have the schedule already. So I need my beginning balance. For me to get my beginning balance, definitely I will need my closing balance of previous year, right? So let me just type equal to, let me link that. So our depreciate, our assets, ending balance, yes, from our financial extract. So this is what we have. Let me link that up here. So my beginning balance will always be my closing balance of previous year. Let me link that. So for now, I'm going to just put in my formula for the total, which is equal to my beginning balance plus my new assets minus my depreciation. So I can highlight everything to the right, press my Control R. So now we need to get our depreciation. Let's calculate our depreciation first. So what do we have for our depreciation? Our depreciation here is saying, oh, our depreciation will be a percentage of our previous PPE ending balance. So which means I'll need to come here, type equal to my depreciation percentage, which is 10%, then multiply by my last year closing balance. I'll press enter, highlight everything to the right, press my Control R. So now the first technique is how do we now get our new property, plant, and equipment here? So for us to do that, let's calculate our inflation index first. So our formula for inflation index is, let me open a bracket, 1, right, plus my inflation rate, I'll close the bracket, then raised to power, open a bracket, my period minus 1. Then I'll close the bracket, press enter. We have that more like in a multiple format. So it is this inflation index that we are going to use. Okay, so for us to now calculate our new property, plant, and equipment, to do that, what we are saying is, okay, if our asset actually gets depreciated with let's say 5,000 last period, that means we need to make a provision in order for us to keep this asset in its best form. Let me take, for example, you buy a car, now you are using it to run your business. I quite understand that most time we usually have your maintenance expenses that you've charged to our SG&A. But the fact that a company gets an asset today and is depreciating does not mean they are not incurring some expenses to keep that asset in the best fit to be used for the business operation. Right? For example, if it's a car that you are using to do your business operation day to day, at times you might need to buy a new tire, right? Something can happen to the engine. You might need to incur some big huge amount on it. So those kind of um uh those kind of expenses can also be capitalized, and that is the concept behind this one. So the fact that you actually bought a machinery worth 1 billion does not mean when you are saying when it's fully depreciated, that means you'll just remove that big assets, right? Because you said depreciation will be over years, and one of the best practice in the corporate world is they usually recalculate depreciation. They calculate depreciation there. That's why we have that asset revaluation. But we are not going into that. So what we are saying is, okay, if our assets get depreciated by 5,000 last period, this asset we want to keep it in the best shape. So let's assume we'll be making provision for that amount at which it has been depreciated, and let's factor in the time value of money. So for our depreciation for the previous period, let's link that here. Our depreciation for the previous period, what do we have? Okay, so this is what we have for that, which means I'll come here, open a bracket. Right? So we are making two provisions for this. Factor of depreciation, and also if the management decide that, you know what, in this also period we might be incurring some capital expenditure, right? Then you add it to it, and I'll type equal to, open a bracket, my last year depreciation balance, then multiply by this my inflation index, then plus this our incremental capex, which we say is more like a management decision. Then I'll press enter. I like everything to the right, press my control R. And you can see automatically I've been able to forecast my uh, property, plant, and equipment, more like the our fixed assets automatically. So which means my model is kind of flexible. If I come to the inputs and I read from the financial data, you know what? In this also period, they might be incurring like, let's say, something like 10 million. All I need to do is type the 10 million and it will automatically flow into my model. Right? So that's the first method. So let me put this back to zero. So you read the financial statement to be able to get idea of, okay, maybe they'll be incurring any capital expenditure at any particular time. Now let's go to the second one. Let me run us through the second techniques. So we've seen the first one, which is more like the effect of what? Depreciation and time value of money. Right. So as I said, I always like to link my input to this my assumption. So this one, let's link our revenue. Let's link our revenue projected to our input, which we have here. And the next one is our property, plant, and equipment. Let me also link that to our input worksheet. And our depreciation as a percentage of our previous PPE. Okay, so let me link that also to our input. Link that to our input. So that's our depreciation factor. Now, this method is the method I called a walk back, by making use of our fixed asset turnover. I'm quite sure we know the asset turnover. Our asset turnover is our sales divided by our average of our total assets. But this one, making use of that ratio. Now, instead of us to use that total fixed assets, let's use it on our property, our PPE ending balance. Know that every value you have in our balance sheet is always our ending balance. So let's try and check the trend of this of the turnover, the fixed asset turnover of this business. And let's do that calculation. That will be equal to our revenue, right, divided by let me open the brackets, average of last year and current year, right? I press enter. Yes, so currently their PPE turnover, right, is 3.6. So let me just copy this to the right, and here we have our 3.62. So this is actually giving us a sense of a trend in their closing property, plant, and equipment every year. So for our forecast, let's just assume, okay, you know what? Let's work with 3.60. Yes, let's work with 3.60. Now let's go straight to our schedule. My ending balance, remember, I always like to link that. Let's link that here. This is our ending balance of our property, plant, and equipment. Then my beginning balance will always be my closing balance of previous year. So let's put our ending balance formula here first. My beginning balance plus my new assets minus my depreciation. Enter. Let me just highlight everything to the right. And we know we just need to fill out our new PPE and our depreciation. Okay. Sorry. Yes. Let's take it a step back. Yes. Yes. Good. Good. We still remember that. We still remember that. Right. So now that we have this, so as I said, this technique is a work back technique, which means we need to first get our ending balance first before we can now forecast our beginning balance, our new capex, and our depreciation. Does that make sense? So we've been able to calculate our PPE turnover, and we can see, we understand that trend from what we have here. And we've assumed that, okay, you know what? Let's just assume 3.60 for the forecast period. So which means I'll need to come here now. Since I have my revenue forecast up here, I'll just type equal to my revenue, then divided by this, my what? My property, my PPE turnover. Press enter. You see that automatically I have my what? My ending balance. If I highlight everything to the right, press my Control R. You will see now that automatically I already have my PPE schedule ending balance that will take straight to our balance sheet. Right? So now let's put in our formula. Beginning balance will always be our closing balance of previous year, right? Write everything to the right. Our depreciation, they said, oh, our depreciation will be the percentage of our previous PPE. So I type equal to my ending balance of previous year, then multiply by this our percentage. Press enter, then I have everything to the right. Right? I hope it's making sense. Now, which means we need to now calculate our what? Our new capex. And that's the reason why I usually call this more like a walk back. Since we have our beginning balance, we have our ending balance, we have our depreciation. All we just need to do is do what? Come and type equal to my ending balance plus my depreciation. One other thing I can do is I can just try and put it, can we put it in a bracket? Okay, so most time when I'm putting my formula, I usually try as much as possible to make it very, very easy for my reader. Then now that we have this, I will just deduct. Okay, no, that's not what we are doing. So equal to, open a bracket, my ending balance plus my what? My depreciation. So that then I will deduct my ending balance, my beginning balance from there. And I will have my what? And I'm going to have my new capex. I light everything to the right, press my Control R. Now for you to know that, okay, your schedule is working fine, let's come and type equal to my beginning balance plus my new assets, then minus my depreciation. They're supposed to give us the same value that we have there. Yes, just for you to confirm. Exactly. So you see that this kind of really makes sense as well, because it's more like a walk back. So you use that our PPE turnover ratio as an element. Get your ending balance first, calculate your depreciation, then the difference is what we now makes up our PPE. Does that make sense? Does that make sense? Does that make sense? So, as a financial modeler, at times you need to understand what is happening in a business. There are some businesses, right? Every 2 years, they usually have this change in their balance sheet shape, right? So you as a modeler too, you should be able to understand that and be able to incorporate that. So this kind of look good, right? I hope we are good with this. I hope we are good. I hope we are good before we go to the third techniques. Now, for the third techniques, it's kind of include. So let me open this up. Usually give rise to circular reference, and there are some school of thought that they really don't support circular reference, because by the time you build your model, you send it to a client, the client does not understand what is circular reference or things like that. But there's no way you build a corporate finance model that you will not have that circular reference. So most time what they usually do is, okay, they will just create a VB or a macro, so that once you open the file, you just click activate and it automatically activates that for us. So let me link our assumption first. Inflation rate, let me link that to our inputs. Our inflation rate, this is our inflation rate, right? Then our depreciation depreciation, which is year now. So we want to get our depreciation lifespan. Our depreciation lifespan, which is 5 years. We're not using percentage this time. So for our new capex, let me just link that to our input worksheet. So for the capex that we have in this new worksheet, we've been able to get that by making use of that our assets turnover techniques. So let me link that here. So for our property, the ending balance, let's link our ending balance here. Link our ending balance as well to our input worksheets. Okay. So first thing is, let's build out our schedule, our ending balance. Let me just link that here. Then my beginning balance will be equal to my closing balance of previous year. Then let me put my ending formula here. Beginning balance plus my new capex minus my depreciation, enter. So let me just copy this because of the format. Let me place everything as formula. Okay, great. So now we need to go ahead and calculate our depreciation. So we call this our waterfall depreciation. Waterfall depreciation. So in case you've not heard about waterfall depreciation, we have a course on it that you can actually check out after the training session. So my depreciation lifetime, that's 5 years. So let me link that up here. So we call it waterfall depreciation. Then for our period, let me type equal to for our period, let's just link that to our inputs where we have our period. See here. Yes. Okay, great. So I have my year here. Also, I will need the year by this side. So let me count 1, 2, 3, 4, 5. I'm going to use transpose. So I'm going to use a transpose here. I also need the year by this side. So let me so I'm still going to transpose that. So this is the amount which is our new capex. Let me link that here and press my Ctrl Shift Enter. Which means we need to now calculate our depreciation here. And what this means is this: if you bought an asset in year 1, definitely you know that depreciation will start in year 1. If you now buy an asset in year 2, definitely you know the depreciation will not start in year 1, it will start in year 2, right? The asset you bought in year 3, the depreciation will not start in year 1, year 2, it will start in year 3 exactly, and that's what gives rise to this waterfall. So let's do this. So we are going to be making use of AND function and some logical function in Excel. So in case you don't know much about logical function in Excel, we also have a course on our Office Training Hub that you can check out, right? So this video will definitely be available on our YouTube channel. Okay, and you can always rewatch this. So the first logic I need to test now is this my year that I have here, which I'm going to keep the row constant, right? Are you greater than? Then I'll open my brackets. The year that I have by my side, which I'm going to log the column, then plus my depreciation year, which is 5 years. I'm going to also keep the row constant. That's my first logic. So I want to see depreciation, when are you starting and when are you ending. So the second one is this. So AND function, we test if you have multiple logical to make sure that all the logical are true before it will return true. If two are true and 1 is false, it will return false for you. So everything must be true before it will return true for us. So for the second one now is our year that we have up here, which I'm going to also keep the row constant. Right? Are you greater than or are you equal to our year that we have by the side? So you see the reason why we have the side, the years by our column and also by the row. So I'm going to keep the column constant. Right? So let me close this and let's see what that will give us. So if I copy this, okay, so let me multiply this by 1. So yes, it's always more easy to read when we have it like 1. So let me copy this and let me paste everything here and paste it as formula. So you can see the waterfall automatically. You can see 1. So this asset is coming here in year 2. His own depreciation will start here. This one is coming in year 3. His own depreciation will start here. So that's what makes it a waterfall. Now we really don't need this one. We need our actual value. So let me multiply that. That's by our what? So we are making use of straight line for depreciation method. So our assets, which I'm also going to keep the column constant, right? Uh, Divided by our lifespan, the asset lifespan, our depreciation lifespan, which I'm going to also keep the row constant. Close the brackets, press enter. So I can copy this and fill it everything down. And you can see we have our waterfall automatically. So let me calculate my depreciation. Total depreciation will be, I will just sum this from here, sum everything together. I like to the right, press my Control R. So now, which means I need to link this to my depreciation that we have in this schedule. Press enter. Right? So yes, the recording will be available on our YouTube. Yes, you can also watch the replay. Yes. After the mail, after the webinar, you also get a link to watch the replay. All right. So now our new capex. Note that I can actually to link this to what we have, to our depreciation our new capex that we have up there. Right? So remember we said we also want to incorporate that time value of money into this. So the fact that, you make provision that 5,000, you are going to incur 5,000 on your capex. We also need to consider time value of money. The 5,000 today might not be 5,000 tomorrow, right? So we also need to consider that. And also the effect of our depreciation, the fact that you are buying new asset does not mean you will not be maintaining the existing one, right? So, and that's what we are going to do now. So I'm going to put my formula here equal to my depreciation. Let me open this up. My depreciation multiplied by my what? My inflation rate. So this is what we have. Then let me add that together with our what? With our new capex that we are bringing in. I'll press enter. I like everything to the right. Press my Control R. Now you can see now that the depreciation that we have in this the asset value that we have in our new capex is different from the one we have in this our depreciation schedule. So which means we need to link these assets. Now, this our new assets, we've added the effect of the existing assets, right? Let's make that as a factor of our depreciation, so that we are maintaining new assets as also as we are getting our new capex. So which means we now need to link this new asset. We need to link it back to this our depreciation, so that the depreciation can now calculate for existing and the provision that we've also made for that existing assets alongside with the new assets. So I'm going to delete this now, and I'll go to press my transpose. This time I will now link it to my new capex that I've calculated here. Control Shift Enter. Now it's going to give rise to a circular reference. Right? So that's why I said that's one thing about this. So in order for you to make this happen, circular reference, we need to tell Excel that, you know what, Excel, we are doing this intentionally. Allow it to flow. Right? So let me click this, and I'll go to my options, then go straight to my formula, and let me click enable iteration. Enable iteration, and I'll click OK. Then I can come back here and type my equal to transpose. Right, go back to where I have my new capex in the schedule, and let me link that here, and you see everything will work out perfectly. Right? So this is the techniques. These are the three best techniques that you can always use in order to make our forecast of our fixed assets, right? So where people build their model, and only capex will be for only year 1 and year 2 to year 5. There will be nothing. Is really not a reality concept. Okay, so thank you everyone. So will the recording of this presentation be distributed to attendees? So yes, immediately after the session, you will get a mail regarding that. So also, please, can you explain the different method used for inflation in method 1 and the one in method 2? You use inflation itself. Exactly. I love that question. So inflation, we have what we call inflation rate, and we have inflation index. So most times when we are using this inflation index really factor in period. Yes. So for the inflation rate that we have here, definitely you know that we have this annually. So assuming the model I'm building is actually quarterly, right? So you can actually get your inflation rates if you want to actually really build your model in such a detailed um, manner, right? But let's assume this our inflation rate. We've assumed this will be yearly, and I'm actually building my model maybe 6 months period. So if I change this to 6 months, now check this, my inflation index currently now is 1.13. If I change it to 6, we see that it really consider it factor in the time value, the time period. Yes, and that's why we call it our inflation index. Inflation index. So one considered the time period, the periodic it's being factored in, right? Just more like the way we have our formula of our we are calculating your NPV. Yes, so it's factoring that discounting factor of timing into it. Why the second one, right? We just make use of the inflation directly. Okay. So thank you. I hope I'm able to answer our question. Then which other one? And I have heard that instruments normally take 5 years to depreciate before it is replaced. Can this demonstration prove how the 5 years was determined? Hmm. Let me read that question again. I've heard that instruments normally take 5 years to depreciate. So you have a depreciation over 5 years, right? Before it is being replaced. Okay, so what we are saying now is we are not saying you're actually replacing the asset. So try and check. You actually got uh, a motor vehicle for your business to be running your business, use and deliver your products, right? Year one, you bought the assets looking good. Then year two, right? Because of the continual use of that vehicle, it's not as if because you have that vehicle now, right? You are like charging depreciation on it. Does not mean you will not make provision to always keep that vehicle in place, right? Such that it's serving that purpose for you. Exactly. That's the concept we are factoring into this. If you have your personal car, right, you can be driving and the tire, something happened to the tire. You have to get some engine oil. You have so all those costs, we assume that you can use it as a basis to make your assumption of your new capex. So it's not a must that you're actually replacing that. You are just making a provision, right? And one of the concepts of modeling that me I usually I love using is let me try and over forecast your cost and under forecast revenue. So when you are now faced with the reality, it's better you have much revenue and make provision for each cost. And when you get there and that cost is really not up to that, as compared to you actually over forecasting revenue under forecast cost, then you make just more provision for that cost and you get to the reality of it. You now need cost. Your cost is way higher than the provision you've made. Does that mean you now need to go back to your investor and ask them they should give you another money or something? So those are the concepts that we also try to impute when we are making this forecast. Okay, so is your Excel spreadsheet and different from a typical uh, Excel spreadsheet? So no, it's still the same spreadsheet, still the same Excel, still the same Excel. So I will share the file with us as well. Yes, so let me share that with us. Okay, yes, so you have the file now. I've been able to share the file with us as well. Yes, so you can have access to that same thing. So it's the same Excel. We are using the same Excel. We are using the same Excel. So that I'll build out my calculation. I can also make my model look good back, right? So you can just see everything looking neat back to what we had when we started our model. So those are the things you can use. Those are the concepts you can use instead of you having multiple worksheets in your model, right? Just make sure you use headings, use cell styles to make your model, and use outline. We call it group outline, right, for our model. So thank you, everyone. Thank you, everyone. Thank you, everyone. I hope we really enjoy the session. We enjoy the session. We enjoy the session. So remember, you can always rewatch this video. I know I was a little bit fast. So we have a discount offer for us. Yes. So you can check our course on our office training up, right? And so let me post that link for us so that we can check our courses on office training up, and you can also make use of 20% discounts on any of our course, both financial modeling course or Excel course or Power BI as well. So please can we have the Excel file and okay, so okay, how can I contact you? Okay, all right. So I've also pasted our Office Training Hub link in the chat box for us. Yes, 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 yes. So, please, can we have the Excel file? So I've shared that with us now. Yes, so check. You should be able to download that now. All right. So, Cheesy, okay, yes, you can definitely contact us. So let me also type our mail for us for you so that you can message us as well.